Wall Street just published 10 major research reports. The message is unanimous. We are witnessing a historic market bifurcation. This is the November synthesis. 5 narratives, 1 conclusion. Here's what the smart money sees. Narrative 1. The AI infrastructure boom is accelerating. Goldman Sachs surveyed 105 investment bankers. 37% of U.S. corporations already using AI in production. 63% in tech, media, and telecom. The projection, 50% adoption next year, 74% within 3 years. But here's what matters. Only 11% are cutting headcount due to AI right now. The productivity gains are going to revenue growth and margin expansion, not cost cutting. AI is currently additive, not replacement. The efficiency phase comes later. The evidence? Amazon Web Services grew 20% year-over-year to $33 billion. Consensus was 17%. AI data center electricity equipment up 150% from April lows. Hyperscalers are, quote, still on the gas. This is the CapEx expansion phase. Narrative 2, the valuation paradox. JPMorgan flags the bubble signals. Mag 7 free cash flow multiples. Apple at 42 times. Amazon at 104 times. 1990s bubble levels. Market breadth is collapsing. Goldman reports the Mag 7 put-call skew has inverted. Calls are now trading higher implied volatility than puts. This historically precedes short-term reversals. But here's the paradox. S&P 500 Q3 earnings per share growth, 12.7% year-over-year, 78% of companies beating estimates. The Big Six actual results are crushing forecasts. Amazon earnings 41.7% actual versus 14.2% expected. Valuations are stretched, but earnings are supporting current multiples. The market is paying for AI future growth while current earnings validate the story. The problem, earnings must continue to beat to justify valuations. Goldman's technical warning. Mag 7 skew inversion, net selling despite weekly gains. This is a reversal signal. Narrative 3, the Fed policy paradox. Everyone disagrees on December. October 29. FOMC cuts 25 basis points to 3.75 to 4%. Vote 10 to 2. Governor Murrin dissented, wanted 50 basis points. Kansas City Fed President Schmid dissented, wanted 0. Powell at the presser. December is, quote, not a foregone conclusion. JPMorgan's Michael Ferrari titled his note, "Not so fast, my friend." December cut probability dropped from 80% to 63%. Bank of America says the Fed is unlikely to cut again under Powell. Nomura says 72% probability. Market too dovish. UBS maintains their December cut forecast. The real story, the Fed is split and data-dependent in an environment where data is unreliable. Government shutdown. Powell said the Fed is, quote, driving a car in a fog. Core inflation still 3%, 2.2 to 2.3x tariff. Labor market, quote, on shaky ground. Critical date, December 1, 2025, quantitative tightening ends. Balance sheet moves to neutral. This could trigger volatility. The trade, markets pricing 63 to 72% odds of a cut. Fed messaging suggests coin flip, asymmetric risk, cut already priced, hold equals significant downside. Narrative 4, the global macro fog. Barclays titled their note Fog and Peace. The U.S.-China trade truce offers short-term relief but doesn't address deeper tariff tensions. This is temporary, not structural. Bank of America's data. Tariffs are adding 30 to 50 basis points to core PCE inflation. Consumers bearing 50 to 70% of total tariff costs. The effective tariff rate is expected to rise further. Apple's guidance embeds $1.4 billion in tariff costs. Barclays flagged it. The November 1st deadline, 100% tariff hike threat if no deal, market went defensive. Gold $4,002, silver $48.19, VIX 16.26. The data problem, U.S. government shutdown equals missing key economic data. October employment delayed. Consumer confidence flat but hard data missing. Global central bank divergence. ECB on hold until end of 2026. Euro area growth better than expected. Bank of England expected to cut 25 basis points, but the vote is 5-4. Fragile consensus. Bank of Japan could hike any time if inflation sustains. Supreme Court wild card. IEEP, a tariff legality hearing upcoming, could alter trade dynamics and Fed policy indirectly. Narrative 5, the earnings translation problem. Barclays called their note trick or treat raise or retreat. Strong Q3 earnings are not translating to forward guidance uniformly. The winners raising guidance, tech and financials, converting beats into fiscal year 2026 upgrades. The losers, energy, 16.4% median EPS beat but flat 2025 guidance, only plus 0.26% for fiscal 2026. Materials, 4.2% beat but minus 1.3% cut to 2025 estimates. The Apple case study, Q4 revenue $102.5 billion, beat consensus. Gross margin 47.2%, above forecast. But operating expense up 18.5% year over year. Revenue only up 11%. Services up 15%. China down 3.6% year over year. December quarter guidance, 10 to 12% revenue growth, but OpEx rising to 18.1 to 18.5 billion. 1.4 billion in tariff costs embedded. Barclays rating, underweight, $230 price target, rising cost structure, uncertain China, modest AI investment versus peers. The pattern, companies beating on earnings but guidance is cautious due to rising costs. Tariffs, AI investment, China weakness, commodity volatility, macro uncertainty. Current earnings support multiples, but guidance doesn't support growth expectations outside tech and financials. Here's what the flows tell us. Goldman's weekly rundown. Week of October 31, U.S. equities net sold. Gross trading activity largest in 7 months. High conviction moves. ETF shorts up 7.3% for the week. Up 8.7% for the month. Financials, most net sold after 5 consecutive weeks of buying. That's a reversal. The rotation. Russell 2000 down 1.9%. Short positioning rising. Nasdaq Russell ratio approaching year-to-date highs. Clear rotation from small cap to large cap tech. Infotech saw the largest short covering in 4 months. Shorts capitulating. October performance divergence. Nasdaq 100 up 5%. Korea KOSPI up 20%. Russell 2000 underperforming. Smart money is trimming. Goldman's year-end playbook, 5 core trades. 1 long secular non-profitable tech. Short non-secular non-profitable tech. Bet on AI, fade everything else. 2. Long U.S. strategic interest industries. Short U.S. firms with high China exposure. Apple minus 3.6% China year over year is the poster child. 3. Long floating rate debt beneficiaries and quality housing. If QT ends December 1st, rates stabilize. 4. Capture AI infrastructure build out. Data center, electricity equipment. Up 150% from lows. AWS Azure Google Cloud acceleration. 5. Hedge post momentum unwind. Exclude Mag 7 from benchmark hedges. Use X7 or SPXX indices instead. Mag 7 skew inversion equals reversal risk. The critical risks. Mag 7 reversal risk. Put call skew inverted. Free cash flow multiples at 1990s bubble levels. Breadth collapsing. The December Fed decision. Market pricing 63 to 72% cut probability. Fed messaging coin flip. Asymmetric risk. The China problem. Apple China down 3.6%. Trade truce temporary. High chip controls remain. The guidance gap. Energy materials discretionary. Beats not flowing to guidance. Rising costs compressing margins. Only tech and financials raising forward estimates. The data fog. Government shutdown equals unreliable economic data. Fed driving in fog. October employment data missing. The valuation extreme. Mag 7 free cash flow multiples 42 to 104 times. Concentration at 2020 levels. Earnings must continue beating to justify valuations. Here's the bottom line. We are witnessing a AI-enabled monopolization of market gains. The bifurcation. Tech plus 25.9% EPS growth. Energy minus 6%, non-cyclicals minus 0.7%, small caps underperforming. The technical setup is precarious. Mag 7 skew inversion, extreme concentration, smart money net selling, ETF shorts up 8.7% month. The trade, long I infrastructure tech plus financials. Hedge Mag 7 reversal risk. Use X7 SPXX not SPX. Short non-secular non-profitable tech and high China exposure. Watch December 1st, QT ends. Watch December FOMC, binary event risk. This is a market running on I optimism with 1990s valuations, but 2025 earnings. The question isn't whether I is real. It is. The question is whether current valuations can be sustained if earnings growth doesn't accelerate from here. With guidance gaps widening outside tech, that's increasingly uncertain. Stop trading blind while hedge funds see everything. Follow Gecko Wire for the same signals.